Hello there, you're watching Bizworld. The Employees Provident Fund EPF investments are not affected by the weakening of the ringgit. Its CEO, Datuk Sri Amir Hamzah, said the foreign exchange impact will only matter once an investment asset is realised.
Say about 64% of my total assets are invested locally. So that base is always ringgit based lah. So whatever the income, whether it's fixed income, equity market, whatever, it's all ringgit based. So I don't have forex on the side. For the ones which are invested globally, it depends on whether I realize the investment or not. If I choose to sell the investment, then the forex becomes much more into play lah. But it's a matter of choice.
He was met on the sidelines of the International Social Wellbeing Conference 2023. Datuk Sri Amir Hamzah is also optimistic on the pension fund's second quarter financial performance. He said although the local equity market was down by 7 to 8% in the first 6 months of the year, EPF has the potential to profit from the market volatility. Meanwhile, global markets have recovered up to 13%, which augurs well for the pension fund. Malaysia is still attracting foreign direct investment (FDI) inflows despite a volatile ringgit. The country's economic fundamentals and long-term prospects are also intact, while access to credit remains widely available to finance economic activities. According to Maybank Investment Bank, Malaysia's trade or current account surplus has been sustained for decades despite its budget deficits. The budget deficit itself is in the process of consolidation, declining from a high of over 6% of GDP during the pandemic years to 5.6% of GDP in 2022. The budget deficit, targeted to be 5% of GDP this year, is seen to be making steady progress to a more sustainable level of around 3 to 3.5% of GDP, targeted by 2025. It is also virtually fully financed by domestic debt rather than external debt, reflecting the high level of internal financial resources. In terms of FDI, approved FDIs were up 52% year-on-year to 37 billion ringgit for the first quarter of 2023. The FBM KLCI may attempt to break the 1,400 level in the short term despite a cautious mood ahead of the US Federal Open Market Committee FOMC meeting and Bank Negara's overnight policy rate OPR decision. Hong Leong Investment Bank HLIB noted the overall trend remained cautious as investors await the US June FOMC meeting minutes away and Bank Negara's OPR decision on July 6. This in the wake of sticky inflation, higher for longer interest rates, recession risks and declining corporate earnings, coupled with political tensions ahead of the state polls. Tracking the mixed regional markets, the FBM KLCI lost 3.4 points to 1,392.5 on profit-taking after a strong debut on the first trading day of the third quarter. Market undertone remains cautious as trading volume was flat at 2.6 billion shares, valued at 1.57 billion ringgit, while market breadth weakened to 1.05 from 1.5 previously. On another matter, the automotive sector's total industry volume TIV for the second half of this year remains strong, supported by over 300,000 order backlogs. This despite the sales and service tax SST exemption for new car deliveries having ended on March 31st. Thus, HLIB Research maintained its forecast of 700,000 units for 2023 and expects TIV to normalise to 650,000 units in subsequent years. Despite the anticipated strong electric vehicle EV growth, the firm reckons its overall market share will be relatively immaterial. In terms of EV demand, it said the government has been encouraging more EV usage with accommodative EV policies. EV sales were 2,631 units in 2022, driven mostly by BMW, Mercedes, Volvo and Hyundai. That's all the time we have for Bizworld this time around. I'm Nadia Azmi. Thanks for investing your time with us.